This video will cover two things: an in-depth investment update on China, including a new investment idea, and 3 important lessons to make you a better investor. No investor is right 100% of the time, including me, and it's better to learn from other people's mistakes than to make them yourself. In my 2023 stock market outlook, I said,
this is different because I think China is likely to be the best market in 2023, but there's a huge risk that they could also be the worst stock market of 2023. So even though I'm optimistic, I would still proceed with caution.
Well, unfortunately, China turned out to be one of the worst markets in 2023. You can see from the purple line in this chart that it started out strong. The MSCI China was up over 17% before the end of January, but after that, it sank into a slow, depressing decline and ended the year down 11%. While the global stock market was up over 20%. In short, at the end of 2022, I saw China as a market that was still down almost 50% from its high in 2021 and was clearly in the early stages of a recovery, as the government removed lockdowns and made a lot of positive pro-growth comments about 2023. Unfortunately, this brings us to lesson number 1. Don't trust the Chinese government. I actually highlighted this risk in my 2023 outlook.
Recent talks of stimulus to come have been really promising, but actions speak louder than words, and we have yet to see what will actually be put in place.
That's the main thing that went wrong with my China prediction for 2023. I was right about the first part, that they would remove lockdowns, but I was wrong about the second part, that it would lead to a strong recovery. I thought that even if reopening didn't spark a recovery in the property market, the government would stimulate the economy enough to make up for it. But the reopening optimism died out quickly. Property companies started failing, young people couldn't find jobs, the economy fell into deflation, and the government really didn't do much about it. Youth unemployment and consumer confidence got so bad that they just decided to stop publishing the numbers, which further calls their credibility into question. Over the last few economic downturns, China has stimulated their property market every time to boost the economy when it was weak. But this time, they didn't. And that's telling me that the priorities of China's leadership could be changing. I'm not saying they'll never take a pro-growth stance again, but the lesson learned here is to take what they say with an even bigger grain of salt than before. Now, as for what's next for China, I'm gonna split this into 2 sections: what could go right and what could go wrong in 2024. And then at the end, I'll tell you about an interesting investment strategy I came up with that can do well in either of those scenarios. Let's start with what can go right in 2024. The bull case is obvious. China's stock market is down over 56% since its high in 2021, which means there's huge upside potential in a recovery. The Chinese stock market is really hated right now. Investors around the world, even in China, are almost universally bearish. The market prices in what is expected to happen, so things don't really have to go that well to be better than what's expected and cause the market to rally. Valuations are ridiculously cheap, which means we're less likely to get another big downturn from here. The domestic regulatory environment appears to be easing, at least a little. They came out with a harsh stance on the gaming industry late in 2023, only to walk it back and fire the head of the gaming regulation a few days later when the market sold off. Tightening regulations were the main thing that drove the stock market down in 2021, so you could take the quick reversal as a sign that they don't want to rock the boat as much anymore. There's also been more positive government rhetoric over the past few weeks, including from the top man himself. I already told you I've decided I'll believe it when I see it, but all else equal, it's better to have positive messages than negative ones. If they do stimulate the economy more like I expected them to last year, it could be a very good year for China. Falling US interest rates could also weaken the dollar against the yuan, boosting returns of Chinese equities for US investors. For me, as a deep value investor, the fact that Chinese equities are so universally hated is what gets me most excited. That often means there's a good buying opportunity, but it was pretty universally hated last year too, and things just got worse. So let's look at what could go wrong in 2024. The bear case is long, which is why people are so negative. Even the South China Morning Post says that China's days of runaway growth have gone. Okay, in no particular order here. Here's the first one. Domestic regulations may be less bad than 2021, but there's still a risk going forward, and the anti-corruption / getting rid of Xi's enemies campaign is likely to continue in 2024. That was number 1. Number 2, demand is still weak, and the economy is still slowing down. Number 3, exports were also weak in 2023 and could slow even further as the global economy slows down, especially if there's a recession. Number 4, China is still fighting deflation, and the longer it persists, the harder it is to correct. Number 5, consumer confidence is incredibly weak. We don't even know because it got so bad last year that they stopped publishing the numbers. The same can be said for youth unemployment, which hit over 20% before they stopped publishing the figures. They just resumed this week after altering the calculation methods. So now it's only 14.9%. Still high, but now also unreliable. Number 6, people have been dumping Chinese assets, which has put a lot of downward pressure on the yuan. If confidence isn't restored, that's likely to continue, and if the US doesn't cut rates at least the 6 times that the market is currently pricing in, US rates could rise and put even more downward pressure on the yuan. Number 7. Most major governments and companies are actively divesting from China and trying to reduce their reliance on them in key areas. Number 8. Geopolitics are likely to remain a key risk for years. The European Commission is investigating the Chinese electric car industry. The China Alcoholic Drinks Association is investigating the European brandy industry, and tensions with the US are unlikely to get any quieter in a US election year, where every candidate wants to compete to show who's tougher on China. Number 9. Tensions with Taiwan could also tick up in 2024. William Lai from the pro-independence DPP party just won Taiwan's presidential election. They don't have the power to push for major change because they don't have a majority in the legislative yuan, which is like their version of parliament or Congress. But China is not a fan of William Lai, so tensions could remain high with periodic flare-ups. I see war between China and Taiwan as a very low probability in 2024. But it would be an absolute disaster for Chinese equities if it did happen. Number 10, stimulus to support the economy has so far been pretty underwhelming. And when senior officials met in December to talk about how to solve the economy's problems, not much came of it. Number 11, local government investment vehicle, aka LGIV debt, is still a major issue that could get much worse if the government decides to start letting them fail. Or it could simply dampen growth if further lending restrictions reduce infrastructure investment. Number 12, the most important development to watch is the housing market. And a solution here could alleviate a lot of the stresses I just mentioned. Various estimates have between 50 to 70% of China's household wealth and property. Change in the value of those assets is especially important because of the wealth effect. When people feel wealthier, they're more optimistic and more likely to spend money. So the health of the property market feeds through to the rest of the economy. Unfortunately, pretty much any way you slice it, the property market is still getting worse. Home prices are down 20 to 50% from their peak in 2021, depending on the city. And the decline has actually been accelerating in recent months because of uncertainty around future incomes and less government support than had been expected. Contracted sales among the top 100 property developers fell 17% in 2023. And remember, that's coming off of 2022 when the country was locked down half the time. Just looking at December 2023 versus December 2022, sales were down 32% and over 60% at many individual property developers. New residential property construction starts fell 39% in 2022, around 25% in 2023, and are projected to fall another 10+% in 2024. Even though they aren't building as many new homes and prices are coming down, inventory levels are still rising. That means there are more sellers than buyers, and there's probably more weakness to come. Until consumer confidence turns around, it's hard to see the housing market turn around. And in that scenario, China's stock market could keep falling. So given the many ways it could go, here's how I'm approaching the Chinese stock market in 2024. When it comes down to it, China is still the second biggest economy in the world and has a lot of dynamic industries. It is highly likely that there will be a big recovery at some point. But when? Now here's where we get to valuable investment lesson number 2. Always look forward. That's that way. Always look forward. Past returns don't matter. Well, except for tax purposes. Everything that will impact the future stock price will happen in the future. And if you get anchored to your original investment thesis and only look for things that support it, you're doing yourself a disservice. As a deep value investor, my instinct all year last year was to add to my position that was way down. But I didn't because my outlook had changed. The property crisis was getting worse. They weren't stimulating the way they said. They started to face deflation and worsening consumer confidence issues. So at the beginning of the year, I thought they were in the early stages of a turnaround. But as time went on, the data no longer supported that. Now, I didn't want to sell because I was highly confident that it would turn around in the long run. But I didn't want to buy more because I wasn't seeing any convincing indications of a near-term reversal. That brings us to investment lesson number 3. Turnarounds require a catalyst. Investments do not turn around just because they've done badly for a while or they're cheap. Usually, they're doing badly for a reason. And so for them to turn around, something needs to change. Otherwise, they'll just keep going down. In order to add to an aggressive Chinese equity position with big upside, like the 3x levered China ETF, YINN, I'll need more evidence of a turnaround. It could happen in a lot of ways, but one interesting thing I'm watching for is if there are more widespread protests because of declining confidence. I've seen reports of people not getting paid for months. Young people can't find jobs. Homes that have been paid for in advance aren't being built on time. There are a lot of reasons it could happen. Now, it takes a lot because China cracks down pretty hard on protesters. But if it gets to that point, I think it could be a catalyst for China to ramp up stimulus and growth-friendly policies more meaningfully. Now, you see, the Chinese government hates instability. And that's exactly what got them to finally remove lockdowns in December of 2022. However, absent any major uptick in stimulus, I think it's hard to imagine a significant recovery. Yet, given how far the market has already fallen and where valuations are now, it's also hard to imagine a significant downturn from here, other than fringe scenarios like a war. Yet, Chinese stocks have been extremely volatile. The combination of those three things, where I don't expect huge upside, I don't expect huge downside, and the market has been really volatile, creates an interesting opportunity. To capitalize on it, I recently purchased KLIP, the Crane Shares China Internet and Covered Call Strategy ETF. Normally, I hate covered call strategies because you take on most of the downside risk of equities and give up most of the long-term upside potential. But usually, the yield on them is no more than 10 to 12%. In this case, since the stocks have been so volatile, the call options are way more expensive and the yield is over 46%. Just to make sure we're all on the same page, a call option is the option to buy a stock at a specified price at some point in the future. So if it goes up past that price, you can buy it for cheaper and then sell it for a profit. However, that option obviously costs money. A covered call strategy buys stocks and then sells call options on them. So they own the stocks, but if they go up a lot, they don't really benefit because they sold away all the upside. Normally, with covered call ETFs, it's one of two scenarios. Either you don't get paid enough, in my opinion, to give up all your upside in a good year, or you get paid well, but take on a ton of downside risk that makes it not worth it. However, I think this case is unique because I don't expect Chinese stocks to fall that much more from here. And I'm getting paid way more than normal to sell the call options because volatility makes them more expensive. That does two things. It gives me a nice cushion if the market goes down, because it may well go down, but probably not by 50%. Could the Chinese stock market go up more than 46% and cause me to miss out on some upside? Sure, but if you tell me I can get a 40% return in a year, I'll take it. The 46% figure can and most likely will move around a lot depending on the changing volatility of the Chinese internet stocks. So I want to take that as a reliable guide of your expected return if the Chinese stock market is flat or up. But look, ultimately, I think this ETF is attractive now because I expect it to have solid upside potential if things go well in China, and decent upside potential even if things go badly in China, as long as they don't completely blow up. In 2023, the MSCI China Index fell 21%. The Crane Shares China Internet ETF without the covered calls fell 22%. And KLIP, the version with the covered calls, still rose almost 10%. Obviously, 2024 will likely look a lot different than 2023, but that's an example of how it can work. If you made it this far, please do me a favor and hit that like button. And if you want to know about these investment ideas a little bit earlier than YouTube, join my free Discord. The link is below in the description. Thanks for watching, and I'll see you in the next video.